I'm Gary Schnitkey, and again, this is our first FarmDoc webinar, and this is going to deal with our crop insurance decisions for 2014. And again, first in the series, and we're going to be first off talking about crop insurance. The topics that I'm going to cover today are four. First off, we've had a number of questions about how the 2014 passage of the 2014 Farm Bill impacts crop insurance. We're going to talk a little bit about that. The short answer is that it doesn't have impacts on the 2014 decisions. We're then going to look and see how performance in crop insurance looked over time, and in particular, we're going to see how or what crop insurance products were used in 2014 and some of the payments for 2014. Then we'll talk about changes from 2013 to 2014. Here I'm going to focus on two: the lower projected prices that we're going to have in 2014 relative to 2013, and also the introduction of the area risk protection insurance, which is our substitute for the group policies that we had last year. And then finally, we're going to talk about product recommendations. So that is the outline. If you want a copy of these overheads, they are linked to the website, and you can download them as a PDF as well. So if you want to go to that website, you can get a look at the PDF of those. So those overheads will be there shortly. So let's begin with topic one: impacts of the 2014 Farm Bill. 2014 Farm Bill passed, and that Farm Bill had no changes in crop insurance for the 2014 year. So the same policies that were available in 2013 will be available in 2014, same subsidy levels. The 2014 Farm Bill did not do anything to the crop insurance policies for the 2014 year. In addition, it is important to note what the Farm Bill did not do. It did not change the combo or the area risk protection insurance product. Those policies will be available in 2015, 2016, 2017. So those policies are not changed. Also, the 2014 Farm Bill did not change the subsidy rates. So the same subsidies that existed pre-2014 Farm Bill exist after the 2014 Farm Bill. So you'll have the combo product available next year, and the premiums from that combo product will not change as a result of the 2014 Farm Bill changing subsidies. So in essence, a lot of what the Farm Bill did do was not much to crop insurance, particularly in 2014. As we move on into 2015, there are two changes that the Farm Bill did do. One, it introduces conservation compliance. Farms that enroll in crop insurance will have to be in conservation compliance for highly erodible land. That requirement, it's likely that the requirements for highly erodible land will be the same as they have been for receiving commodity title payments. So that conservation compliance is now will be extended to crop insurance in the 2015 bill. The 2014 Farm Bill also introduces supplemental coverage options, and this again will be in 2015, so this is not available for the 2014 year. And what it does is it offers a county product based on county revenue or county yields, depending on your underlying combo product choice, from 86% down to the coverage level of the combo product. What impacts that will have on crop insurance decisions will have to wait till next year. We will be analyzing that. There will be a FarmDoc webinar on March 12th dealing specifically with SCO, but again, the SCO will not be an impact for the 2014 cropping year. But again, that's 2015, so we'll be looking more at that as we're moving on into the the 2015 cropping year. But suffice it to say that the Farm Bill passing for 2014 crop insurance decisions has no impact, really. The combo products are the same. It made no changes to the underlying products that are offered for the 2014 year. So, given that, we're now going to move on into how crop insurance has been used on corn and soybeans. In Illinois, the slide you're looking at here is showing the percent acres insured for corn in 2013. So if you look across the top, you'll see the list of the products, plans, RP, RP with harvest price exclusion, YP, GRIP HR, GRIP, and GRP. Two things to keep in mind as you're looking at this list, or there's 4 numbers in the red. If you go to the RP policy and you look at RP, 75, 80, and 85% coverage levels, you'll see that those 3 coverage levels have 3 of the highest percentages, 34% and 85%, 25% and 80%, and 10% and 70%. If you look at Illinois for corn, 34, 25, 10, 70% of all planted acres were insured with RP 75, 80, and 85% coverage levels. So the predominant policy in Illinois for corn is RP at higher coverage levels. And the highest use of the coverage level in RP is at the 85% coverage level. The other area is GRIP HR. 6.6% of the acres planted acres were insured. Total of 87% of the acres were insured in Illinois. So that's the next biggest block of areas, GRIP HR. If you're looking at those 3 products, or 4 blocks, or RP, GRIP, HR, and think about those as where most people are at. If an individual was there last year, they will likely be happy to be there this year. So if you have been using those policies and have been satisfied with those, then making no changes for the 2014 year likely will be a choice that will be good. Here is the same slide for percent acres insured for soybeans in 2013. Again, you'll see the same sort of numbers here. 14% RP 75, 80% coverage level 24%, and 85% 22%. So RP at high coverage levels and GRIP HR are the 2 predominant policies used in Illinois. Again, both for corn and soybeans. Over time, the major trend in both corn and soybeans and crop insurance coverage using these multi-peril products is movement to a revenue product and increasing those coverage levels. This shows coverage level use or percent of acres insured by the 75, 80, and 85% for RP. So this is revenue protection. Prior to the introduction of RP, we're using CRC and RA as a gauge of the coverage levels. So RP hasn't existed over this entire time period. But as you can see here, 85% coverage level was not available in 96 and 97. Since that point in time, it has increased, and now the 85% coverage level in 2013 was the highest used. So over time, we've seen farmers switch from 75 and lower coverage levels into the 80 and 85% coverage levels. And that switch has accelerated in 2008. If you look at 2008 there, that was the year in which we saw the introduction of enterprise units, higher subsidies for enterprise units, and that was one of the events that caused those use of those higher coverage levels. So If you're a farmer, have a 85% or 80% RP policy, and you're pretty normal for what's used across both corn and soybeans in Illinois, and for that matter in the entire Midwest. Here, just to give you a feel for how crop insurance performed last year, 2013, I'm showing for corn here different coverage levels, 50 to 85%, farmer paid premium, indemnity payment, payment minus premium, and then policies earning premium. And this was as of February 26. And just let's go down to the 85% coverage level down at the very bottom, and look at some of the numbers there. At an 85% coverage level, average farmer paid premium for corn across the state was $26.16. Those policies had an average indemnity payment of $46.92. So in 2013, that 85% coverage level had a $47 payment. Much of that payment resulted because of the decline in the harvest price over the projected price. So $46.92 was we're getting feedback from that mic. $46.92 for payment minus premium of $20.76. So last year, RP policies had a $20 indemnity payment over the premium, and 50% of the policies earned in premium. Again, last year, much of that result was because of the lower projected or harvest price over the projected price. And you can see there that happened in the 80% coverage level as well. Soybeans are slightly a different story. You can see here, and again, looking at the 85% coverage level on soybeans, $18.03 was the average farmer pay premium in Illinois for soybean policies. $6.68 was the indemnity payment, lower than the farmer paid premium. Again, last year in soybeans we have a $12.87 projected price, $12.87 harvest price. So we didn't see any change in the projected and harvest price, and in fact, same harvest price as projected price. You couldn't do that if you tried. So last year, minus $11 difference between payment minus premium, and 18% of the policies earn premiums. Again, these two slides do illustrate the power of crop insurance in protecting against lower prices, particularly at higher coverage levels. There was a distribution of those payments across the state. Here are just maps that show payments minus premiums. Corn, you'll see a lot of more green across the state. Northeast corner had some pretty good yields, and they are the one area where we're looking at payments being less than the premiums for corn. For soybeans, much of the state had lower payments than premiums. We just had the introduction of county yields this week. Based on those county yields, we estimated the payments for GRIP for last year, 90% coverage level, 100% protection level, the highest coverage level, the highest protection level. You can see those payments for corn acres over on the map, and again, you see there that there are some pretty large payments. For soybeans, payments were much less, and there were 4 counties based on these are preliminary estimates just based on NASS yields. RMA hasn't released these payments yet, so we're looking at we will be looking at RMA later on coming out with these payments, but these are estimated based on release of NASH yields this week. Again, we saw larger payments for corn because of that price decline, $5.65 down to the lower harvest price. Again, illustrating the power or the performance of crop insurance when we're in a declining price environment. But to summarize here, what we see farmers and most insured acres being is RP at a higher coverage levels, 75, 80, and 85%. GRIP HR, the other one, county level, at a 90% coverage level. For corn last year, about 50% of the higher coverage level policies, RP policies, make payments for corn, much less for soybeans. And GRIP HR is going to pay in quite a few counties across the state, again because of the lower harvest price than the projected price for corn. All right, now we're going to move on into 2014 and look at the changes that exist in 2014, and there are two changes that I want to highlight here. There are several others, but these are the two big ones. First off is that the projected prices in 2014 are going to be lower than they were in 2013, and that is going to cause our guarantees to be lower as well. The second change is that RMA introduced the area risk protection insurance policy, and that replaces the group policies. So right now we're just going to go through those changes and look at what each one of those do for, or the impact of those on crop insurance choices. First off, projected prices for corn and soybeans aren't completely known yet for the 2014 year. They are set based on settlement prices during the month of February. We have 2 days to go yet, but we're really close to knowing what those are. For corn, the projected price is going to likely be $4.62, maybe $4.61, maybe $4.63, but right in that $4.60 to $4.63 range. $4.62 price would give you a price that is slightly over $1 lower than the projected price last year. Last time we had a lower price was in 2009 when we had a $3.99 projected price. So 4 years ago we had a similar price to what we're looking at in 2014. For soybeans, the projected price is likely, well, it's going to be close to $11.35. Center 2 either way. Again, we have 2 days left to determine that. That will be lower. $12.87 was last year's projected price. Again, the last time we had a lower projected price than we will have in 2013 was in 2010. Those projected prices are going to lower guarantees, and here I'm just giving you an example of both premiums and guarantees for a Macon County, Illinois situation. Let's start here first with the premiums. Again, we still, these premiums are close, but we still don't know those exactly. We'll know those after the price and, more importantly, the volatility number is released. Last year, an 85% coverage level policy in Sangamon County with a 186 bushel trend adjusted yield would have a $25.49 price. Premium in 2014 will be $21. We're likely to see lower premiums in 2014 than in 2013 by a couple dollars at the higher coverage levels, and that will vary across counties. So some counties may be more or less, the decline may be more and less than that. per acre guarantees here will be for last year. If we had 186 bushel trend adjusted yield, we had an $893 per acre guarantee. This year, $729, and here I just used the same APH yield, trend adjusted APH yield. Over $100, over $150 lower guarantees in 2014 than in 2013. That is primarily, again, because of lower, well, that is due to lower projected prices. Again, we are going to be looking at a different risk reduction environment in 2014 than we were looking at in 2013. If those projected prices hold, here is the prices, the harvest prices that will have to result before we have a payment. And this assumes that the actual yield is the same as the trend adjusted APH yield. So what I'm trying to do is give you a feel here for how or what sort of prices will have to happen before crop insurance will make payments. Corn, $4.60 price, 85% coverage level, and this is just the $3.91 price is 15% less than the $4.60 price. We would have to see prices below $3.91 before we get crop insurance will cause payments, given that actual yield equals the trend adjusted APH yield. So we're looking at below $4 prices in all cases before crop insurance will make payments on corn in 2014. Soybeans, 85% coverage level, $9.65, 80%, $9.08. Again, we'll have to, on soybeans, be looking at prices below $10 before we're making payments, given that yields have not declined. So, different sort of production environment this year compared to last year. Second big change was that that last year's, here's a list of last year's products: RP with harvest price exclusion, YP. First three are all farm level products make payments based on what happens to farm yields. Those still exist into 2014. GRP, GRIPs or HR were all county level products, area insurances, and those no longer are available in 2014. They are replaced by the area risk protection insurance policy. The area risk protection insurance policy, again, replaces all the group products. This process is similar to what RMA did with the combo product a couple years ago. A couple years ago, RMA replaced CRC, RA, APH yield insurance with the combo product, one policy that had different plans in. They're doing the same thing with the group products. Now we'll have an area risk protection insurance policy, and you'll choose one of three plans: area risk protection, or area revenue protection, excuse me, ARP with harvest price exclusion, and area yield plan. Those three are analogous to RP with harvest price exclusion, and YP. A, in this case, means it's based on county level yields rather than farm level yields. Area risk protection replaces GRIP HR. So if we were purchasing GRIP HR last year, the insurance this year would be ARP, and it's a revenue insurance. It does have a guarantee increase in it. ARP with harvest price exclusion does not have the guarantee increase, and AYP is a yield insurance. I'm going to just describe some of the differences between ARP and GRIP HR. And ARP is the plan that will replace GRIP HR. Here are some of the bigger differences, and these are covered in a January 7th, 2014 FarmDoc Daily Post. ARP, number one, ARP coverage begins when planted. That is the same as GRIP HR, but now under ARP, planting must happen by a final plant date, which is late June for corn, mid-July for soybeans. The dates vary by county in the state, with southern Illinois having a little they vary a little bit across Illinois. So if planting doesn't occur by those dates, ARP is not covered or does not offer coverage. Second, producers must complete production reports. That differs from GRIP HR in that production reports were not needed. Now for ARP, those will be needed. Third, we're going to choose a production factor rather than a protection level. And change of terminology, but essentially doing the same thing. This year it will be a production factor rather than a protection level. You can, the 1.2 protection factor will be the same as a 100% protection level at a 90% coverage level. So you can get the same sort of coverage with ARP that you did with GRIP HR. Final change with GRIP ARP, our payments under ARP will be lower than GRIP HR at very low revenues, but those low revenues are not likely to happen. In a large extent, ARP will offers the same sort of coverage as GRIP HR did, and we'll give an example of how that works here in a minute. But those are the two big changes, differences in projected prices and also the introduction of ARP. What I'm going to do now is give our product recommendations, and then we'll go from there. Here is sort of the basic product recommendation, and most farmers will find this to be acceptable and very good, and this is actually where most people are at already. So if you're at this place, there's not a lot of reason to make changes in 2014. RP, revenue protection at a higher coverage level, 75, 80, and 85%, using enterprise units with a trend adjusted APH yield endorsement. So using that trendy TA APH yield endorsement to get a higher APH yield or guarantee yield. We'd suggest that this will be a policy that most people will find very, very good. Again, most people are here already. One of the things that I would suggest is to not lower the coverage level from last year. Heard some discussion about trying to save funds or save cost, which is one of the things we have to do. I don't think I would start with crop insurance, because while we're looking at lower revenues and these guarantees will be lower, costs have not come down. So if we don't provide ourselves the downward price protection, we still have pretty far to fall. So I would suggest not lowering coverage levels, and then if anything, if you were at a below 85% last year, might consider moving up some this year. Again, here are premium cost for RP. This is for a Macon County example. We have our 2014 crop insurance decision tool available from FarmDoc. That's available for download. It will be quoting the exact premiums by next Monday after we know what the projected prices and volatilities are. Enterprise units here you can see at 85%, $16 enterprise unit policy or price, farmer paid premium, 25 for basic and 20 a bit higher for optional units. So enterprise units have those lower premiums. Again, enterprise units are all of one crop in one county. You do need to meet certain eligibility requirements revolving around having land in 2 sections and at least a certain amount of land in each section. Again, we would suggest being in enterprise units unless you have a lot of variability in land. Again, the reason why is because the premiums are lower, and in general, if you're thinking about risk, what you're concerned about is whole farm risk, so enterprise units get closer to that providing that. RP hasn't changed at all from last year. Its guarantee is the same. You take whatever the trend adjustment APH yield is times the projected price, and the guarantee will be higher if the harvest price is above the projected price. I'm giving an example here for corn and soybeans, but corn for 190 bushel APH yield, 460 projected price. Here I have a guarantee for an 85% coverage level where the harvest price is below the projected price. So that $743 guarantee results from APH yield, projected price, times the coverage level. RP has that guarantee increase in it, and if our harvest price is above the projected price, here I'm using an example of $6, the guarantee will go up. Again, that was very useful in the 2012 drought year. If you had that RP, harvest price went up, and we had larger indemnity payments in that year. So this guarantee increase is important for those drought years when we tend to have lower yields and higher prices. Again, RP will make per acre payments. Here I'm showing those per acre payments for different harvest yields and different prices. RP is a farm level policy. It makes payments based on what happens on the farm. It has replant and preventive planting payment provisions in it, unlike ARPI or the group policies, which don't have those in them. Again, we believe that most producers, farmers, and landowners will find this a good place to be. RP policy, 75, 80, and 85% coverage levels. Who should use RP with the harvest price exclusion? And again, farmers that use the harvest price exclusion may be considering lowering premium cost in some way. So individuals who are cost conscious may wish to use RP, and those that don't do much pre-harvest hedging. And again, the guarantee increase on RP is particularly useful for individuals that do pre-harvest hedge and protecting against those years in which prices decline. If you take RP with harvest price exclusion, there is a risk of lower payments during the drought. And here, this bottom panel illustrates this. I'm showing here farmer paid premium for RP with harvest price exclusion. You can see the acres insured with both of these at an 85% coverage level. Premiums were $29 for RP with harvest price exclusion $15. So saved $15 in premium overall. But the payment was $326 for RP versus $128 for RP with harvest price exclusion. Again, RP with harvest price exclusion will make much lower payments in those situations when prices go up compared to RP. The guarantee for RP premium cost will be much lower than for revenue protection, RP with harvest price exclusion. Here you can see $5 cost for RP with harvest price exclusion versus $16 for the RP product itself. Again, what you give up when you go to RP with the harvest price exclusion is that guarantee increase. Here's the guarantee. It won't increase if we have a higher harvest price, and as a result we'll have differences in premiums when harvest prices are above the projected price. When harvest price is below the projected price, there won't be any difference in premiums, but here that $5 price, we will see differences in premiums again because there is no guarantee increase in it. RP with harvest price exclusion likely to be good for those individuals that want lower premiums. Again, giving up that risk protection when higher prices result. Who should take ARP? And again, this is the substitute for GRIP HR. Those individuals that are more concerned with price protection may find ARP advantageous. Those individuals that can only take basic units for whatever reason, or have APH yields that are much lower than expected yields. This may result from a farmer moving into a new county, not having APH yield documented, you having to use transitional yields. This case, ARP may be a good alternative. When we're taking ARP, we would suggest taking it at 90% coverage level, and again varying the protection factor which varies from 80% to 120%. Varying that protection factor will raise or lower the premium, and will do the same thing to payments when they happen. Example of the premiums for ARP, you can see here how the protection factor impacts the premiums at a 90% coverage level. 1.2 protection factor has a $43 cost. We can lower that to $28 by using a 0.8 protection factor. The example here, I'm going to give an example of for Macon County. Each county has an expected yield. 182.8 is the expected yield. Guarantee for ARP will be the higher of the projected or harvest price. 460 here is our projected price. Coverage level of 90%. We get a $757 guarantee. Again, that's based on county revenue. So county yield times the harvest price, and when that's below that guarantee, a payment will happen. The other factor that farmers will have to choose is the protection factor. And this again differs from the protection level last year. Here we have the farmer choosing a protection factor of 1.2, giving us a protection level of 1,009. The way this product works is when we have revenue shortfalls, they'll take that percent revenue shortfall times that protection level here. Shortfall times protection level to result in the payment. If that protection level is lower, the payment level will be lower. Again, that protection level choice of the protection factor can range from 0.8 to 1.2. Here are three examples of protection factors, or shortfalls given a high yield, high price scenario. Here we have harvest revenue of $700, which is below our guarantee of $757, and we get a shortfall of 0.94. Average yield, average price, $190, $430, $817. There's our harvest revenue. That is not below our guarantee or shortfall of 0. Drought, $110, $6 price, $660 revenue. But note our guarantee has gone up, and this happened in 2012 as well. 4.414 price, or excuse me, 0.414 shortfall. Here's you see the calculation of the shortfall. It's not necessarily intuitive, but if you the way this policy works, you get the same payments at most revenues as you would under the old GRIP HR policy. Here's the shortfalls. Multiply those shortfalls by the protection level, and the protection level goes up as well with the projected price, and you see payments listed there for the Macon County corn example. GRIP HR, 6% of the policy's acres were insured with it in 2013. Again, it provides good price protection, maybe good for those individuals that are more concerned about price falls, because we have that 90% coverage level rather than the lower one, and or have lower expected yields. Summary here, product choice. Most farms will find RP at a high coverage level, enterprise unit, TAAPH yield as the choice. You were there last year, just stay there. If you were GRIP HR last year, you're going to have to switch to ARP. There's not a lot of reason for those to change. Other alternatives are ARP for those that are price conscious or for whatever, or more concerned with price risk, and or have lower expected yields than for their combo product than is realistic, or lower APH yields, and RP with harvest price exclusion for those that are cost conscious. Appreciate this time. Now what we're going to do, we've had a number of questions come in, and we got those written up here. I'm going to repeat those questions and sort of go through them and answer them as we're going as we're going through this. So first question here, do you think other Corn Belt states use similar coverage levels to that for Illinois? And the answer is yes, they do. Iowa will be very similar. Illinois will be Indiana will be very similar. Much of the Corn Belt it uses the same sort of coverage levels as we do in Illinois. For a long time, actually, Illinois lagged other states in terms of the coverage level and insurance use of Iowa, for example. Those differences have caught up, or they're about the same right now. Another question. Of the total 85% corn premium, what percent is farmer paid? So if we're looking at an RP policy with 85%, the RMA calculates a total premium, and farmers pay a percent of that total premium, and the remainder of that is subsidized. Those subsidy levels are right now my mind is going blank with what the subsidy levels are. It's right at 50%. We'll find that out, and we'll get that to you. But it's right at 50%. They vary by coverage. They vary by coverage levels, and we'll make sure that we get that posted. Another question. In the new Farm Bill, is it mandatory that you sign up for crop insurance in order to sign up for the new farm programs? No. The crop insurance programs are not linked to the commodity title programs. So you don't, particularly what you sign up for 2014 crop insurance will not influence at all what you can sign up for as far as the commodity title programs. Moreover, next year, the commodity title programs, whatever you choose, you can still choose the same combo products that you have available and the same ARP product. So 2015, if you've chosen RP 85% or 2014, you will be able to choose that for 2015. The one thing that the Farm Bill will do, or your choice of commodity title program will influence whether or not you have SCO available, which again is a band of county coverage above the combo product. Again, let me give you an example here. Let's say you chose an RP 80%. Next year, you would have a SCO alternative if you chose the price loss coverage. Whether or not that is good or not we'll have to wait till next year. Let's do the analysis. It's hard for me to see a lot of benefit from SCO at an 86% coverage level, but let's do the analysis and look at that in more detail next year. No reason to buy next year's problem in this year's decisions. In area revenue plans, are the yields trend adjusted? The expected yield in the area yield plans are calculated using a trend adjustment procedure. It differs from that used in the trend adjustment for the combo product, but yes, they are trend adjusted. Yield plugs and premium systems. We have just a note here that there are, if you have a combo product and you have a low yield, you can plug a portion of the transition yield in for that. So there are cases in which you can substitute a different yield for a very low yield. Another question. I heard there is a maximum payment for AARP, and yes, that is true. There is a maximum for ARP payment, and that is why, if you go back to what I was saying here, I just put the differences between ARP and GRIP HR. Payments of ARP are lower than GRIP HR at very low revenues. That happens because there is that maximum payment on ARP. Those maximum payments, in my estimation, will not be reached under any sort of realistic situations. They would have not happened in the 2012 Farm Bill, or excuse me, after the 2012 drought. So it's hard for me to see situations in which those maximums really matter a lot. But yes, they are there. Another question. If I intend to enroll in County ARC, should I lower my 85% RP policy to 75 or 80%? And the answer I would give to that is no. And there's while you might have seen a lot of cases comparing crop insurance and ARC, and there being this added coverage on top of that, the two products address different items. Let's say you do take ARC County next year. All right, and we do have a payment. You will not get that payment until 2015, after the marketing year is over, and ARC County is actually designed to provide protection against multi-year price declines. You can think of crop insurance as providing within-year price and revenue protection, and the ARC product as providing across-year protection. And again, we will be doing more analysis on this, but at this point in time, I would not suggest lowering a coverage level on the 2014 product because you're anticipating taking ARP. The recommendation to take a fairly high coverage level on crop insurance this year results a lot from where we're at from a price standpoint and a risk standpoint. If we're not we are at a point where we have very high cost, and if we have any sort of price 15% revenue declines, we're going to be looking at loss situations. So I would suggest sticking with the 85% RP. Another question, does the Farm Bill say that landlords have to have the same coverage level as the tenant? All right, Farm Bill, landlords, and let me give you, for crop insurance, a share rent landlord and the tenant can make different choices of crop insurance. So the Farm Bill says nothing about the crop insurance choices. And again, the question was, does the Farm Bill say that landlords have to have the same coverage level as the tenant? No, they don't. The commodity programs, the landlord and the tenants will have to agree on the commodity programs, which, so there's a difference there between commodity programs and crop insurance. Another question, if we download the 2014 decision tool today, will it auto-update once the prices are final next week? You can update it. It doesn't auto-update. There's update parameter buttons on the crop insurance decision tools that you will have to hit to get it to update. But if you download it today, we will update the, if you hit that update parameters, it will update. Another question. If an insured isn't concerned about the harvest price, would the YP be a good option? If not, why not? If an insured isn't concerned about the harvest price, would the YP be a good option? If not, why not? So I'm assuming that all we're concerned about is yield variability, and somehow they protected on the price side. So a yield protection policy would work for a case where you're not concerned about yield or price losses. It's hard for me to see situations in which that may be the case. Could be the case if we've already hedged a lot of the grain, maybe have 100% of the hedge, then maybe YP would be the case. So if you've got the price side covered, then YP may be a good alternative. If you got the price side covered, though, depending on how you got it covered, if you got it covered with futures prices, I would be tempted to take RP because you probably want some protection against adverse events in case the hedges go against you. If you got it by calls, then or excuse me, by puts or some call strategy, then you might be thinking about YP. Can we double, this is another question, can we double paid with the 86-75% insurance on the one new farm program option even if we buy 85% RP? This is going to be more complex than that, but all right, and you're getting into next year, so this is next year, so we can't play this game this year. If you're paying 85% RP, the SCO policy that you will get will be from 86% to 85%, 1%. Can you get double paid on that? Yeah, you can, but it won't be much. The real question will be, will you want to use an 80% RP policy or drop the RP policy and substitute it for an SCO policy from 86% down to 80%? My initial reaction to that is you probably will not. The gains of that will not be large. And the reason why I believe that is because it's at 80% coverage level. If this had been at 90%, then I could see where that would be more advantageous. Another question, if SCO doesn't apply until 2015, will we not get some time to decide whether we want to choose ARC or PLC? All right, well, we are speculating now here, but ARC and PLC, if you have PLC, you will be able to choose SCO. If you choose ARC, you will not choose SCO. FSA, Farm Service Agency, will have to, hasn't released the timing of that ARC PLC decision. But once you make the ARC PLC decision, which presumably will be August this year, maybe, who knows, FSA hasn't released the rules, but it will be before you have to make your crop insurance decision. You will have to abide by that decision. So you will make that program choice before you will make the commodity title choice. If you choose an insurance program in 2015, are you precluded from changing insurance programs in crop years after 2015? And if so, for how long? No. All right, so let me read this question again. If you choose an insurance program in 2015, are you precluded from changing insurance programs in crop years after 2015? The answer to that is no. And here the crop insurance programs I think we're talking about, or I'm talking about, are combo or ARPI. You can make those decisions the same in each one of those years. Or you can make different decisions in any one of those years. You're nothing from this year influences or limits your decisions next year. You will be the ARC PLC under the commodity title, which is different from a crop insurance, will be a one-time decision made by a deadline, likely August, maybe a little bit later than that. FSA hasn't released the rules yet. They're in that process of releasing those right now. That will be a one-time decision. So difference there between commodity titles and crop insurance programs. Again, crop insurance programs, the combo product, RP with harvest price exclusion, YP, aren't influenced hardly at all by the Farm Bill. So those products are stable. There'll be changes in premiums, but it will be due to loss experience. It won't have anything to do with what has happened in the Farm Bill. Are there new options to choose that give more months from which to calculate the harvest price? All right, so there's a number of add-on policies that give the option for additional price to have the higher of, for example, December, January, and February as the projected price. There are policies that would allow you to have the higher of February, March, April, May, June, or a selected number of months. And there's a number of those policies. I am not aware of any that allow a difference in the harvest price. For those policies, for those individuals that are interested in those policies, they look like reasonable programs to me. Here's what I would suggest though. If you're going to think about your crop insurance bill, max out on the federal side before you do an add-on. That means, for example, take RP at an 85% coverage level before thinking about an add-on. The reason why I say that is because federal crop insurance is subsidized, so you might as well take advantage of that subsidy. It is, by the way, 9 o'clock. We have a number of questions yet. We're going to keep going till 9:15. Appreciate your time here today. Thank you for coming if you came. But we have a number of questions yet. We're going to keep going for a little while. One other note is that this is the beginning of our FarmDoc webinar series. We will have another one in a week, dealing with a lot of the questions that we're getting now on the Farm Bill. Another, is there an adjusted gross income limit in the new Farm Bill? Yeah, and again, that's where we'll have a whole webinar. Actually, the next two webinars will deal with the Farm Bill. And yes, there is. There's a $900,000 AGI limit. Another question, who will qualify in 2015 for the beginning farmer discount on crop insurance? And I do not know. That's something we'll look into, and we'll make sure that we have the answer to that for our next webinar. Where do we download the crop insurance tool? Let me see if I can show you this. You do this at the crop insurance website, a farmdoc, and I'm going to try and show you where that is right now, if I can do this. I'm now, you hopefully are seeing a web browser, but I'm going to go into FarmDoc, and if you go into FarmDoc and you come down here, you can either get that in the Fast Tools section or the Crop Insurance section. You go into the crop insurance section, you'll see some of our tools here, our iFarm Crop Insurance Evaluator, Premium Calculator. If you click here, you can get online quotes for premiums. We have preset premiums. For APH yields, you can get online quotes. And then right here is our crop insurance decision tool, which is a downloadable decision tool. It's available. If you click here, you can download it, and it will be, and it's a Microsoft Excel tool. And it requires, obviously, Microsoft Excel. You download it, it's available right there. Will the TA web sheet tab be updated for 2014? Yeah, we're working on that. Actually, we have that done, and that version of it will be up there today. Do you know when the 2013 NASS yields will be released? Yes, they have been released. They were released this Tuesday, and they are available on the NASS website. And so they are available. If prices drop in the fall this year to $3.75, what will be the payment and the premium on an 85% RP policy for your Macon and Sangamon County examples? All right. I am going to you're now looking at the crop insurance decision tool. I'm going to go into the what if section and go to Macon County. and I believe I had a 189 bushel. Hold it. We are having a, is it there, Mark? We were trying to show the crop insurance decision tool, and the technology has gone by the wayside. Well, let me just give you the answer. I tried to be too fancy. All right, it does depend on the yield, obviously, but I got an 85% RP policy, and I'm using a 190 bushel APH yield. And if we have, I'm going to give you a 370 price. If we have a yield of 190 bushels, we would have a $42 payment. If we have a yield of 200 bushels, we would have a $5 payment. And if we had a yield of 160 bushels, we would have a $153 payment. See, we've lost the screen. So I don't know, but that'll give you a feel. For GRIP and ARP for 2014, are the expected county yields lower as a result of the 2012 crop year? They might have been. I have not looked at the expected yields, but each year they do add the yield, and the expected yields might have caused those to come down. Actually, the couple counties that I looked at, they were about the same from 2013 to 2014. But adding those lower yields for 2012 will likely lower expected yields for ARP. Another question, would a producer be better off taking yield insurance rather than giving up fall price protection to lower premium? All right, so here I'm assuming the question is, we don't want to pay the premium for RP, which has both, but we would like to have lower premium. So would we be better off with RP versus YP? And again, I would tend to think about YP as a case is coming back to what I'm doing marketing wise. If I have some price protection built in already through some marketing arrangements, put strategies, calls, or some option strategies, I might be willing to take YP or be shaded towards YP versus RP. I would get a bit concerned about taking YP or RP if I've done some forward contracting or I have used futures contracts. While we're all focusing a lot on lower prices for 2014, if we do have a drought in 2014, we will again see higher prices, and we might be seeing $4.60 projected price now, a harvest price of $6. If that's the case and we've done forward contracting or used futures prices, we're going to face some losses there, and neither RP or YP will provide protection against those losses. If on the other hand we've done option strategies and are fairly satisfied with the floors offered by those option strategies, using YP would be a good alternative. Trend adjustment option. Comments on the trend adjustment option. Most farmers will find the trend adjustment option advantageous. You will either be able to have the same coverage level at a lower cost or a higher coverage level. it is advantageous for most farmers. And by most farmers, I mean 99.5%. Those farmers that will not find it advantageous are those that have very low APH yields and have used a lot of plugged yields in getting their APH yield. In that case, trend adjustment does not help and in fact may hurt. So if you're in a situation where a lot of plugged yields, low yields, then you might not use the trend adjustment. Rest of the cases, APH is a good alternative. Before 2013, we're very closely to use a tree. Before 2013, our premiums were very closely predicted by the farmdoc crop insurance calculator. They were not very close. Do things like farm pass yield variations and other things kick in that are not known in the calculator? The only thing that influences so if we're using the trend adjustment and farmdoc premiums weren't close, there was something missing about the APH yield and the trend adjusted APH yield. Those are the only two parameters that matter. So somehow if the question was, the farmdoc evaluator was close until we began using trend adjustment. The only thing that matters, again, is APH yield versus trend adjusted APH yield. If they're differing, the APH and trend adjusted APH yield might have differed. The process of calculating the trend adjusted APH yield and APH yield can get complicated if we have missing years in the data in the yield series or go back far enough in the yield series. My guess, if they were off by a lot, we had a very low APH yield compared to the trend adjusted APH yield. So begin looking for that in those situations. We are past our time. Appreciate your patience today. This is our first of our farmdoc webinars. You go to our webinar series, you will see that we have a couple more. Next week was one on the farm bill. If you go to the website, you can download the PDF of the overheads. This webinar also will be recorded, and you can review it again. We appreciate your time, and we hope that you've enjoyed this and you found it valuable. Thank you for your time, and we will see you around the bend.